Imagine this. Tomorrow morning you open your bank account and there is an extra $100,000 sitting there. Maybe it came from selling a house. Maybe it was an inheritance. Or maybe your extremely suspicious uncle finally paid you back. But there is one condition. You cannot spend the money. You have to invest it. And whatever income it produces becomes your new monthly paycheck. So, what do? Do you choose the safest portfolio and accept a smaller check? Do you put everything into the stock market and wait? Or do you chase the biggest monthly payment and hope the machine does not start eating itself? I built 5 different $100,000 portfolios to find out. One pays only about $83 per month. Another pays close to $900. But the biggest paycheck is not automatically the best portfolio, and the reason could save you from making a very expensive mistake. I am ranking all 5 on 3 things: the income they produce today, how much risk you are accepting, and whether the portfolio still makes sense 10 years from now. And at the end, I will show you the one I would actually choose. Before we begin, 3 quick rules. First, every portfolio starts with exactly $100,000. Second, the income numbers use the latest official yields available when this video was researched. Yields move, because they are more like the price of an Uber ride than the price printed on a cereal box. They can change next month. Third, these are before-tax estimates. Your actual result depends on your account, your income, your state, and whether the tax code wakes up feeling friendly. This is an educational experiment, not personal financial advice. Now let us meet our 5 contestants. Portfolio number 1 is the growth machine, 100% in a broad S&P 500 fund such as VOO. This is the portfolio people recommend when they say, just buy the market. VOO owns roughly 500 of America's largest companies. You get technology, healthcare, banks, consumer brands, the whole corporate buffet, for an expense ratio of just 0.03%. But if your goal is income today, the buffet gives you a very small takeout box. VOO's official 30-day SEC yield was around 1% when this video was researched. On $100,000, that is roughly $1,000 per year, or about $83 per month. That might cover your phone bill, but it will not cover your rent unless your landlord is a very generous golden retriever. So why would anyone choose it? The answer is that this portfolio is not trying to give you the largest check today. Its job is to grow the value of your money over long periods. Vanguard itself describes it as more appropriate for long-term goals where growth is essential, and warns that the price can move sharply. Income score, 1 out of 5. Safety score, 2.5 out of 5, because stocks can fall hard. Long-term growth potential, 5 out of 5. Current monthly income, approximately $83. Keep that number in mind, because we are going much higher. Portfolio number 2 is the Fortress, 100% in ultra-short U.S. Treasury bills through a fund such as SGOV. Think of Treasury bills as lending money to the U.S. government for a very short time. SGOV holds Treasury bills with 0 to 3 months remaining until maturity. In plain English, your money is not locked into a 10-year financial marriage. These are very short dates. At the end of July 2026, SGOV had a 30-day SEC yield of 3.57% and a trailing 12-month yield of 3.79%. To keep the comparison conservative, let us use the 3.57% SEC yield. $100,000 times 3.57% equals roughly $3,570 per year, or about $298 per month. That is more than 3 times the income from the growth portfolio, with much less price movement. SGOV's 3-year standard deviation was only 0.21%. Translation: compared with stocks, this portfolio drinks chamomile tea and goes to bed at 9. But it has a weakness. If short-term interest rates fall, its future income falls too. The attractive payment is not tattooed onto the portfolio forever. Income score, 2.5 out of 5. Safety score, 5 out of 5. Long-term growth potential, 1 out of 5. Monthly income, approximately $298. This is excellent for protecting money you may need soon. But for a 30-year-old trying to build wealth, 100% here could be like buying a helmet and then never riding the bicycle. Portfolio number 3 is the Dividend Builder, 100% in SCHD. SCHD owns about 100 established U.S. dividend companies. It does not simply search for the company waving the biggest yield in the air. Its index also screens for business quality and dividend history. As of the end of June 2026, SCHD's trailing distribution yield was 3.30%. Its 30-day SEC yield at the end of July was 3.23%, and its expense ratio was only 0.06%. Using the 3.30% trailing distribution yield, $100,000 would represent approximately $3,300 per year, or $275 per month on average. Notice something strange. That is slightly less current income than the Treasury portfolio. So did SCHD lose? Not necessarily. Treasury income can decline as interest rates change. SCHD owns businesses that can potentially grow their profits and dividends over time. The share price can also rise or fall because this is still a stock portfolio. The simple version is this. Treasury bills are like renting out a parking space at today's rate. SCHD is more like owning a small fruit tree. The harvest is less predictable, but the tree can grow. Income score, 2.5 out of 5. Safety score, 3 out of 5. Long-term growth potential, 4 out of 5. Monthly income, approximately $275. Right now, the Fortress still produces the larger check, but our fourth portfolio tries to combine both worlds. Portfolio number 4 is the Sleep Well portfolio. It puts $50,000 in VOO for growth, $30,000 in SCHD for dividend growth, and $20,000 in SGOV for stability and short-term income. This is not designed to win any single category. It is designed to avoid being terrible at anything. Using the same official reference yields, about 1% for VOO, 3.30% for SCHD, and 3.57% for SGOV, the estimated annual income looks like this: $500 from VOO, $990 from SCHD, and $714 from SGOV. Total, about $2,204 per year, or roughly $184 per month. Wait, less income than both SCHD and Treasury bills? Yes, and that is not a calculation error. Half the portfolio is allocated to the low-yielding growth engine, but this portfolio has multiple jobs. VOO tries to grow the capital. SCHD provides dividend exposure. SGOV creates stability and gives you money that is less likely to be down when an emergency appears. It is the financial version of bringing a jacket, sunscreen, and snacks. None of those items is exciting until the weather changes and everyone else is miserable. Income score, 2 out of 5. Safety score, 4 out of 5. Long-term growth potential, 4 out of 5. Monthly income, approximately $184. This will not win the income contest, but it may be the easiest portfolio for a normal human to hold when markets become chaotic. Now we reach the portfolio with the giant paycheck. Portfolio number 5 is the income cannon, 50% JEPI and 50% JEPQ. These funds hold large U.S. companies, but they also use an option strategy designed to generate monthly income. You do not need an options textbook to understand the trade. Imagine you own an apple tree. Someone pays you cash today for the right to buy some of your apples later at an agreed price. You keep the cash, but if apple prices suddenly explode, you may not capture the entire upside. That is the basic personality of a covered call strategy. More income today, but potentially less participation when the market races upward. According to JP Morgan's official materials dated March 31st, 2026, JEPI had a 12-month rolling dividend yield of 8.40% in its fund story, while JEPQ had a 12-month rolling dividend yield of 11.16%. These are historical distribution yields, not guaranteed future returns. Using 8.40% for $50,000 in JEPI produces about $4,200 per year. Using 11.16% for $50,000 in JEPQ produces about $5,580. Together, that is approximately $9,780 per year, or $815 per month before taxes. That crushes every other portfolio for current income in this comparison, but the payment is not guaranteed, and the trade-off still matters. Income score, 5 out of 5. Safety score, 2 out of 5. Long-term growth potential, 3 out of 5. Monthly income estimate, approximately $763. So the income cannon wins, right? It wins one contest, but we have not finished the ranking. The mistake is believing income and return are the same thing. If a portfolio pays you $10,000 but loses $10,000 in value, you did not discover an infinite money cheat code. You moved money from one pocket while the other pocket developed a hole. JEPI and JEPQ do not promise fixed distributions. Their payments can change, and they still own stocks, so their prices can fall. Their option income may also create more tax friction than qualified dividends depending on the final tax character and your account. And when markets rise quickly, selling calls can limit some upside. This does not make them bad. It simply means their job is current income, not winning every possible market. The same logic applies to all 5 portfolios. VOO is not bad because it pays only $83 per month. It is doing a different job. SGOV is not perfect because it looks safe today. Its income can fall if rates fall, and inflation can quietly eat the purchasing power. SCHD does not guarantee dividend growth, and it can decline with the stock market. There is no portfolio that is simultaneously the fastest, safest, highest paying, lowest taxed, and best looking. If someone claims to have one, check whether that person is also selling a course from a rented Lamborghini. So here is the final ranking, but I am separating highest paycheck from best portfolio because mixing them would be misleading. For current monthly income, in 5th place, VOO at approximately $83. 4th, the Sleep Well portfolio at roughly $184. 3rd, SCHD at approximately $275. 2nd, SGOV at roughly $298 using its current SEC yield. And 1st, the 50/50 JEPI and JEPQ portfolio at approximately $763 per month. But which would I actually choose? If I were young, employed, and did not need the income today, I would choose the growth-focused portfolio or the Sleep Well portfolio and reinvest everything. If I needed the money within a year or two, the Fortress would make more sense than gambling my emergency fund on stocks. If I wanted growing dividends and could handle market declines, SCHD would be a reasonable candidate. And if I were already retired and needed current cash flow, I might use JEPI and JEPQ as part of a diversified portfolio, not necessarily the entire portfolio. My overall winner for the average person is the Sleep Well portfolio. Not because it pays the most, it clearly does not. It wins because it gives every dollar a job. $50 out of every 100 pursue growth, 30 pursue dividend growth, and 20 protect liquidity. It is simple enough to understand and diversified enough that one changing market condition does not control the entire outcome. Here is the real lesson. Before asking, which portfolio pays the most? Ask, what problem must this money solve? If the problem is next month's bills, income matters. If the problem is retirement 20 years away, growth matters. If the problem is sleeping at night, stability matters. $100,000 can produce anything from roughly $83 to more than $700 per month in these examples. But the larger payment always comes with a trade. Less growth, changing income, more volatility, or more complexity. The best portfolio is not the one with the largest number on the screen. It is the one you can understand, hold through a bad year, and use for the job your money actually has. Which of these 5 would you choose? The growth machine, the fortress, the dividend builder, the sleep well portfolio, or the income cannon? Comment your answer below, and include your age range and goal, because the same portfolio can be brilliant for one person and completely wrong for another. And if you want, in the next video, I will test exactly how each of these portfolios behaves during a major market crash. Subscribe, and I will see you in the next one.